Welcome to Ryan Research. I'm your host, Peter Ryan. I am joined today by Dan Gray of Odin, and he is their head of research. And he has been for a long time writing about the ins and outs of venture capital as an asset class, as how it connects into the broader economy as the engine of innovation, and how things have changed over time. And so, this is a great opportunity to learn more about how venture capital is actually driving a lot of what we see in the broader economy, in public markets, outside of public markets. And so I would like to welcome Dan to the show. How's it going?
Thank you very much for having me. Excited to get into it.
Cool. So, as I like to do, is there anything you just want to preface with your bio that I didn't touch upon, just to give listeners a good introduction to yourself?
It's a good question. Yeah, to frame the kind of stuff I write about with my background is like maybe it's not super obvious, but I have a weird mix. You know, prior to Odin, I worked in private market valuation, so that's like one interesting angle on all of this. Before that, it was really like 20 years of being in a mix of mostly startups, but also some time at accelerators, incubators. So I've seen a lot of different sides of this.
So, to start us all off, what is venture capital?
That is a question that has become kind of complicated to answer. If you'd asked that question 20 years ago, maybe 15 years ago, like it would have been pretty clear. I think the classic definition, and I'm kind of stealing from Will Quist of Slow here, he describes it as funding experiments that are fairly cheap to run, but if they work, they have a huge payoff. And obviously there's like a quite a high percentage chance that they don't work. That's why you have the kind of cheap entry, but that's kind of how the economics used to make sense. Today it's a fairly different beast. It encompasses a lot of strategies that go much further beyond that, like which some of them I would say maybe aren't venture capital or more like subscale PE.
And could you broadly describe, like decade by decade, how venture capital started and how it's evolved since then?
It started, I mean, you know, depending on how you want to define it, like you could go all the way back to the merchant banks and like funding the the spice trade and like all sorts of examples of like anyone taking a bet on a low probability outcome that would be hugely profitable if it worked out. Like it's kind of venture capital, and in some ways it's more like venture capital than a lot of what happens today. Then, through the 60s, 70s, you had the rise of venture capital, more as we know it today in the US, obviously primarily in San Francisco, based around semiconductors. A lot of it related to government programs, defense programs as well. Um, and really, like, I would say, like, m more hardware. Like, obviously, like, it wasn't really software investing in those days, for all that that's what it's known for most today. But I think there was just like an appetite for anything that fit that risk profile. The risk profile was like the proposition. Then I think you get into the late 90s or even like late 80s, like the early part of the information technology boom, the rise of software. And that's really where I think the model started to break because there was m like companies that were way more scalable, which is obviously like very interesting to a VC, but the economics of that become kind of abusable. At some point with a software company, you can keep feeding money in and it will keep growing because it can, spend money on advertising and whatever it wants to, and that produces some return. But the question is, does that actually produce more valuable companies over time? And I think that kind of leads to where we're at with venture today, where it's very good at producing growth, but it's not necessarily very good at producing value.
And would you describe the current state of venture capital as in a crisis?
Yes. Like certainly an identity crisis. Yeah, as I alluded to, like people don't really understand what it is anymore. Like there's m maybe some kind of schizophrenia about like which which strategy is really venture capital, the one that's a lot larger and a lot more dominant, but doesn't really fit the traditional risk profile, or the one that resembles what it used to be, but is increasingly like a rounding error of the total activity. So that's definitely a problem. And then there's bigger questions connected to that about is do we define venture capital, if not by kind of risk profile and investing strategy, is it tied directly to innovation? In which case, is venture capital today doing the same job as it has done historically with driving innovation? And if this is kind of like a Peter Thiel argument of we wanted flying cars and we got 140 characters, the last 25 years. I don't think we've really seen a lot of meaningful innovation, certainly for the like ZERP period of low interest rates when money was everywhere. Anyone could raise a fund. There was arguably like the lowest level of innovation. So that I think speaks particularly to the crisis of like what venture capital does.
And can you speak on to more of your specific essays where you've dived into the statistics around this and uniquely how the ecosystem roles of public markets and private markets have shifted and how that's actually starting to distort the entire like innovation pipeline that venture capital is supposed to be the kind of custodian of?
Yeah, I think you can kind of start by looking at like small early stage VCs, and historically they kind of like represent what venture capital should be, I would argue. But the way the market is structured, particularly the compensation, the incentives around that, is if you have a very small fund as an early stage manager, you obviously make like 2% management fees on the capital you're managing. That's your like your income, that's how you run your fund. So your incentive is to grow your fund over time as you become more successful. That has a kind of like a well-studied effect of making those managers, as their fund sizes grow, they move later because they're more mature companies that can absorb more money. It's a bit less risky, so it helps manage the career risk aspect of all this. So essentially, like as they develop experience, they abandon the early stage, which is kind of crazy because the early stage is the hardest part. Like, in theory, that's where you want the most experienced managers with, the greatest wisdom, the most awarenesses of like the biases at play and so on. And that I think creates a real problem. That end up ends up connecting to, if you look at how capital flows through all of this like towards the exit, then you have a bunch of managers with very large funds who are basically looking for places to allocate that money that can absorb it. And all they really need is investments that will be marked up enough that they can raise the next fund and hopefully a larger fund. So they're looking for short-term growth. And that is like fundamentally at odds with what venture capital should be, which is like patient money for long horizon, like ambitious ideas that may take, 10, 15 years to work out in some cases. So then you have the problem of a ton of investors managing a ton of money, investing in companies that can grow very well, but again, like maybe aren't producing the value that they need to be attractive acquisition targets or IPO candidates, so they can't exit. And then there's no money coming back into the ecosystem. And then like to round out this slightly long and rambly point, as the money coming back into venture from liquidity events starts to evaporate or starts to, to be blocked up a little bit, that hurts the new managers because the more experienced established managers, they can raise money more easily. So you have this weird problem where it becomes harder to enter for earlier stage VCs. And at the same time, the ones who are there and are good are moving out of that category as well. And that's just a really weird and quite toxic dynamic, I think.
Do you view this as not to start talking about kind of villains necessarily, but more of like structural incentives? Do you view this as a problem in terms of who these LPs are or who the fund managers are? As in, is there a new cadre of LPs that are going after as people are trying to scale their funds and find new sources of capital? Or is it particularly kind of a shift in the type of fund manager that is sort of leading those shifts?
Yeah, I think the simple answer, and I think it's probably mostly true, is that you have to look at the top of the stack. That's where the buck stops. So that's the LPs for sure. Ultimately, they decide which managers get money, who gets to invest. That's always the LP's decision. So the big change there over the last 15 years or so has been the growth of like large institutional LPs, particularly like sovereign wealth in the last 10 years has started to play quite a large role in venture capital. And the difference, like the crucial difference with these LPs is the money is being managed by like an agent, a manager hired by the LP to do so. It's not their money. So they're investing based on, I would say, short-term incentives about like, they'll get a bonus based on performance after 4 years. But VC investments don't produce liquid returns within 4 years. So therefore, they want to see big markups, paper value growth. And that's like again, it connects to this question of like what's valuable versus what just shows growth. There's also career risk problems in this as well. If you know you're going to be, working at an endowment or a sovereign wealth fund managing their money for a while, but you're going to move on to another job probably in 5 or 6 years, you have no incentive to make sure that like the 10 to 15 year horizon for liquidity looks good. All you care about is that like the 4 to 6 year returns on paper look good. And there's signaling within that as well, where even if there's some doubt about the legitimacy of the like theoretical returns, if you've invested in big brand name firms or if you have exposure to like well-known household name companies, that looks good for you. And again, it has nothing to do with what the returns are going to be, but it's all just like confidence building, essentially.
And so does this get down to how the evolution of who the LPs are has shifted over the decades? And while it doesn't happen all at once or in like kind of a linear line, my diagnosis kind of traces a critical inflection point back to 1979 when the US Department of Labor relaxed the Employee Retirement Income Security Act of 1974, which allowed pension funds to invest in venture capital for the first time. And so this is a big inflection point that shifts a ton of capital into VC. And it's something an economist that I believe we both enjoy and appreciate, Paul Gompers, who I
Hmm.
see you cite quite often. He's written about this. And you basically have this shift from what you were getting at before, which is kind of the contrarian venture capitalist who is looking at innovation at the early stage that's hard to predict. And there's really, there has to be some expertise there in terms of the domain specialty and the sort of investment strategy. But now, with the introduction of like pension funds, and as it grows to sovereign wealth funds and so forth, for lack of a better term, it turns into this thing of there's a bunch of dumb money that's coming in, and the dumb money determines who the fund managers are, and those fund managers determine who the startups that move ahead are. So, do you view that inflection point in '79 as something critical, as I do? And do you view that evolution from kind of the contrarian, kind of individualist investor to these kind of broad pension fund type of investors as part of this crisis development?
Yeah, for sure. I don't know. This is something I need to read a little bit more about. I don't know if it was primarily 79 or if it was the National Security Markets Improvement Act in 96. That was another big moment of deregulating private markets that brought in a ton of new money. But certainly, like the direction over that period of time was deregulation and a lot more money flooding into venture capital, which has produced the problem we have today. Now, like the big caveat to this is it's obviously a good thing if startups have access to more money and if like innovation and technology has access to more money. There's huge positives to that, but the question is like it all ties back to these incentives. Who's managing the money and how are they motivated? So if you talk, for example, to like a solo GP today who has a very non-consensus strategy, who knows they're going to invest in companies that are going to grow very slowly, but may ultimately have amazing outcomes, but they're not going to show it very quickly. If you ask them who their LPs are, they will mostly be principals. They'll be LPs who actually own and manage their own money because they're willing to be patient and they care about the long term and they care about actual cash returns. Whereas the big institutions who have a manager doing that on their behalf, that's where you get the problem with the short-termism. So yeah, over time, that's definitely become a problem. The question I think becomes quite important to ask is like, how do you fix that? How do you correct those incentives, particularly for the large LPs? There's not a lot of easy answers, but it's also curious how like the industry is very reluctant to embrace, financial literacy in a sense, but like certainly practices like valuation just like immediately rejected. Even though they might help solve this problem, they kind of take away the magic of venture capital, so they're like not considered. So you wonder to what extent the industry's been captured basically by these incentives. Like, can it even be changed at this point?
Yeah, it seems that the again that domain expertise and uh, understanding the unique methodology that, like, as much as there's a mystery to venture capital, like there is a methodology of how you prepare a company in 5 to 10 years to exit into an IPO, and creating the conditions and prerequisites to do that. So it seems that things have shifted away from the ideal version of that, where it's focused on the company and the core product or service that it's offering. And it's moved into just this relationship of how do I impress this dumb money cohort of LPs with short-term metrics that are gamifiable, um, to keep raising ever greater rounds for my own fund. And then by lieu of that, I kind of create a center of gravity by the more that I raise, the more that my friends raise, the more we can keep kind of the slush going. And
Hmm.
we're able to self-perpetuate at some scale. So do you think that's where it shifted? And then what do you believe are those kind of vanity metrics that are being used in lieu of the more valuable metrics that determine company success?
Yeah, I think we could look at an example, like not to pick on anyone too specifically, but maybe let's say Databricks. That's a company, I forget when their first round was. Like maybe it was 2000, 2012-ish, somewhere around then. But that was an investment of Andreessen Horowitz at the time. And the famous story is that they wanted to raise something like 200,000 and Horowitz said like, no, no, we're going to give you 2 million. So kind of already getting them on the venture capital conveyor belt, force feeding them money. That company is still private today. It just raised its Series L, God knows how many billions of dollars. Think about what that does for a firm like Andreessen Horowitz. It's a giant company. They've been putting new money into that company this entire time, like larger and larger checks. And all of the money that they put into Databricks is money that they're charging fees on. So it's basically just a giant vehicle to soak up venture allocation. As long as it can keep growing in value, that reflects as like positive IRR for Andreessen Horowitz's funds. But guess who decides what the valuation is? It's whichever VC leads the round, and guess who that is? It's Andreessen Horowitz. So definitely kind of like marking their own homework to an extent. Maybe that's not true of every round, but you know, in in principle, that's the problem. So then you get into the question of how do you measure valuation to begin with? Venture capital has a huge problem of like just a lack of sophistication about this. Most of the time it's looking at revenue. So what is the revenue of the company and what is the growth rate of that revenue would be a consideration. For mature companies and slightly more sophisticated investors, they might look at like gross margins as well. But really it's revenue is what's driving all of this. Revenue, you know, if you talk to a public market investor and ask them like, can you make a good judgment on the valuation of a company based just on revenue? They'll look at you like you're crazy. Like cash flow matters essentially. You want to know like how profitable is the business? You know, do they have moats that allow them to maintain their margins or grow their margins over time? You know, you basically have to see into the business all of the intricacies of the financial performance to make these judgments. But that doesn't work in venture capital because that adds a load of friction. So instead, they just say, oh, we just look at revenue. And as long as that keeps going up, which it will, as long as we keep giving it money, it looks good. And therefore, the companies get bigger, they keep absorbing money, that produces more allocation to charge fees on. Is that going to end well for Databricks when it goes public? My suspicion would be not.
And this gets into two essays that you highlighted to me earlier, which I encourage listeners to check out: Hitting Escape Velocity and Heavy is the Head That Wears the Crown. And this gets into the dynamic of overcapitalization in these firms that allows certain metrics to be gamed. Like, I think there's a line you used where are we creating companies where their product is to sell $1 bills for 86 cents? And so there's a nature to this where, well, of course, with enough juicing, companies can sputter along and find, customers who will take some sort of product on the cheap. Uh, but you actually go into quite a bit of detail to describe the ways in which more money actually might not always be optimal for the progression of a startup company. And in fact, as you use the term over and over again, this is actually making those individual companies more brittle, and it's thus making the entire asset class more brittle. So, can you expand on your core thesis of those articles?
Yeah. So building on everything I just said about Databricks as the, let's call that like an example of like the problematic status quo. And then looking at research that covers like mostly the research looks at like very early stage companies or companies around the point of IPO. There's not a lot of research that looks in the period in the middle, but I think you can infer a lot of the same lessons. There's a great study by Startup Genome that looks at what happens when a company raises too much money, and essentially it they over-index on growth. You know, they spend too much on advertising, they spend too much on hiring, whatever it's going to take to scale the company rapidly, they do that because that's the incentives of venture capital want growth. So they just plow ahead with that. What that does is, you know, you scale a company along like one dimension and all of the others, which could be like how good are your economics? Are you running efficiently? Do you have proper product market fit? All of these other fundamental questions get kind of left behind. As long as you can show growth, even if that growth is very fragile and may not last into the future, or you know, you may lose your moats, it doesn't matter. And basically what this does is it greatly increases the risk of failure for early stage companies. The trade-off is maybe for some that succeed, they succeed much faster. So like maybe that's what the VCs throwing tons of cash at them, maybe that's what they want. Maybe weak companies dying very quickly and strong ones growing very fast is desirable to them. But I think if you looked at the math, you'd see like the net outcome is actually very negative. And it's also killing good companies as well as bad companies. Like there's no distinction, there's no discrimination. if you look at data at like Series A, so for companies that have, some traction, a proven product, they're doing quite well. There's enough there for an investor to kind of get a read on the quality. The amount of money that they raise at Series A, even at that point, has no correlation with how much they'll return at exit. So it's still basically a guess. There's a very minor correlation. It's probably mostly selection bias, but like it's basically not a factor. So even at that point, the idea that like giving companies more money helps ensure success is obviously false. And then to fast forward a little bit all the way to exit, if you look at the companies that raise the most from venture capital and then IPO, they almost all struggle, and they really struggle. Like the 10 companies that have raised more than 3 billion and have then gone on to IPO, 8 of them are like down massively. One of them's up very marginally, and one of them's up like quite a bit. I forget which is which. Like Airbnb, I think, is one of the positive examples, and Uber's the other, I think. But generally, it's disastrous. Like the net return for that pool of companies is like negative 63%. Like it just clearly doesn't deliver good long-term returns, and that's basically because they've been brought up in this environment of really easy access to capital, but capital that has to be spent on like fragile unidimensional growth and not creating really strong businesses with good economics. There's a funny comparison I wrote about the other day, which is Rivian versus Tesla. Tesla raised, I think, like 110 million from VC, 180 million or so in total from private markets. Rivian raised over 10 billion. Look at the stock prices now. Like, could you guess which one was the private market darling? I don't think so.
And I think there's two ways that you define this overcapitalization having a negative impact on these companies well, which is you focus on one, the capacity to pivot, and two, the discipline of frugality. And so these are ways in which actually like crystallize a successful company where the statistics show that successful companies have at least one pivot usually in their life cycle in the private markets. And the way in which they get more VC than they need actually creates a burden of overspending, and that overspending leads to way more resources, way more personnel, way more commitments that they can't easily change. So it's like trying to turn a jet ski in the water versus a cruise ship. One is inherently more nimble, one is inherently like you're not going to be able to turn on a dime. And then two, on the frugality point, like it is kind of this weird balancing act is like they need money to clear a hurdle, but the more money they have, the less discipline they have in actually understanding what they have to truly triage and cut and innovate their way out of a problem. And more than just the core product, like just sort of a business administration function can be an innovation. So I think those are very tangible ways people can understand the detriment that overcapitalization is. So could you speak to that? And then I do maybe at the end of your explanation of that, maybe get into the fact that there are VCs emerging that are actually subsidizing, not with exactly cash, but subsidizing workflows and personnel in a way that basically disable the individual startups from having to build that competency on their own.
Yeah, both very interesting topics. On the first one, on the pivots, I think the exact finding of the research was startups with at least one pivot had a higher rate of success. Not like it's maybe like a quibble, but like not necessarily that the pivot increases the odds of success, but like certainly there's benefits. So then the kind of implication of that is if you raise a ton of money and you spend it on growing an idea that turns out to not be the right one, chances are you just blow up. Whereas if you spend very frugally, you have a bit more flexibility to adapt and pivot if you need to. Certainly, your what VCs you do have will be more forgiving if less money has been wasted. On the other point about platform teams, that is interesting. It's it's definitely become like I think it's marketed as a value add for companies that the platform team is there to support them, add some support on core functions. But I think the reality is that the platform team is there to help the the GPs, the partners, manage a ton of investments. It's more like a, you could think of it similarly to like the cynical interpretation of what HR is supposed to do or what HR actually does as a corporate function. People think HR is there to support the employees, but it's actually there to protect the company from the employees. That's kind of like a similar dynamic to platform teams, I think.
Yeah, so to get into a specific case, it's said that A16Z has developed a Hollywood model of creating all these in-house competencies, HR, accounting, so forth, that once they have a new startup, they kind of plug that startup in like a mollusk. And then the in-house team is actually doing competencies that the startup otherwise would in a prior decade. So this to me, I'll take the kind of cynical critic point of view here, is that combined with your theories of overcapitalization and the direction of VC as an asset class, it seems that by creating this Hollywood model, um, this is actually servicing that incentive structure that is directed towards LPs, where if we could, dress up, if we can perfume the pig of our startups
Hmm.
to gamify their revenue numbers, to kind of make them look good, to kind of allow them to function where they otherwise couldn't and float on their own, you're not developing those in-house, like kind of collective synergies, collective competencies, and you're actually like kind of infantilizing the founders, it seems
Hmm.
like, and like all this like founders first crap that goes on. And it's like you're actually, it seems like you actually don't care about the founders so much as like you don't want them to be successful executives. And that this, it's not lost on me that like the fact that it has concluded in calling itself a Hollywood model is kind of like a tongue-in-cheek joke to like, a lot of these companies are, hot air of like a Hollywood, fiction that is only there to sort of have a presentation towards the LPs. So where do you align with that cynical perspective and where do you disagree with it?
I think I'm mostly aligned with it. There's a like this is maybe a small tangent, but there's a funny story. I forget the actor's name. He's some like quite well-known actor, but he's a Swedish guy. Um, and he was early in his career, he had a chance meeting with Danny DeVito. And Danny really wanted to meet him because he said like, oh, he's an amazing actor. He disappears into all his roles. Like he had no idea what this guy was going to look like in person or what he was going to act like because he was so lost in all of his characters. Like amazing acting. But then ultimately, Danny gave him the advice, which is like, this is going to be very hard for you because actually, what Hollywood wants is not really good actors, it's stars. They want people who are like really recognizable. You know them immediately from the poster. Like, Sylvester Stallone in every movie, he's Sylvester Stallone. He never does anything else, pretty much. Arnold Schwarzenegger, similar thing. These are that's the star quality. And that's kind of a similar story, I think, if you look at a firm like Andreessen Horowitz, like Adam Newman is a star. What has he done that's like particularly crazily innovative or important in the world? I would argue not much, but he's a star. He can raise money really easily, so they love him. It's one of the unfortunate ways that the venture capital world works today. The other point I'd make on platform teams, but also on like every every function of venture capital that's appeared in the last 5, 10 years, where like it seems to have created benefits to scale. Like another obvious one is brand. Like suddenly every venture firm wants to have like a media arm and like they want to have a podcast and a newsletter and like brand's really important. It's basically nonsense. Like that stuff does not get you better returns, and it's the returns that are what matter. But the reason why that narrative has been built is because it all supports the idea that scale in venture capital is good. Because the bigger you are, the more attention you get, the bigger your brand, etc. And it's all pushing back on the idea that if you look at historical data from venture capital, like big is bad, actually. Big funds mean worse returns. Because of the simple math, it's harder to produce a higher multiple on a bigger number. But they're kind of desperate to challenge this idea because it challenges the entire kind of thesis of like scaled venture platforms. So they invent this stuff like platform teams and media arms to justify that scale has an advantage when it's, I think, the honest take on it is it's a disadvantage.
And if it is possible, how would you describe a divide between an A16Z versus a firm like Fred Wilson's Union Square Ventures? If, while there's overlap, are there two archetypes that maybe they represent, or maybe criticisms that their individual, top guys have written about? I'm thinking about particularly Fred Wilson's, what was it called? The Venture Capital Math Problem, where he talked about the nature of scale and venture capital, and that funds raising too much assets under management sort of leads to this math impossibility where there's just not the returns and quantity available in venture capital as an asset class to justify as much money is under management. And when you actually look at a chart over time of like assets under management of A16Z versus Union Square Ventures, you actually see there's this huge like exponential curve for A16Z, and it's kind of a flat line for Fred's firm. And the idea there is like they took a deliberate decision to not raise more capital, even though they have all of like, the cred on the street to justify it. And so do you think that is something that is worth creating a divide to describe these two archetypes in venture? Do you agree with Fred on his venture capital math problem, so forth, so forth?
Yeah, I think definitely like if you wanted to pick two firms that were really good examples of the two ends of the spectrum, like they're definitely like top of the list probably. USV, Fred Wilson, Fred Wilson is quoted in my piece about kingmaking because he said like he consistently sees that the companies that raise the most at Series A do the worst. Or like some I'm paraphrasing, but something along those lines. Like the amount of money raised was a negative. He also wrote in 2019 about the failed experiment of venture capital using capital as a weapon or capital as a moat, um, which obviously still lasted for another few years after that. But I think ultimately he was right that it was a failure. Um, but yeah, like they are like yeah, small fund optimized for finding important companies and delivering efficient returns. So the highest multiple that they can achieve on the capital that they invest. Now, while the incentives and like typical incentives would push them towards larger funds, maybe they've gone a slightly different way. Like maybe they've increased their fees, maybe they take like 3% instead of 2%, I don't know. Maybe they have a better rate of carry. Probably they do if their returns are really good anyway. Or maybe they just make a ton of money from having a load of really good returns and getting carry on those outcomes, which is another way to do it. And you can make a lot of money if you're a really good investor, even with a small fund, if you can wait for the carry. And that's some of the problem for a new manager is it takes a long time. The kind of charitable case for the scaled venture platforms is that they pull in a ton of money, which, as we've discussed, like more money like has some quality to it. They also bring more political power. So there's an argument that like Silicon Valley should be more engaged in Washington, like lobbying more in some areas has some benefits, but like that's kind of a weird subject with a ton of negatives as well as positives. But like maybe that's a reasonable ambition if it's well executed, is to create a more favorable policy environment for tech as well. But the question I think you really have to ask is which firm, like relative to the amount of capital that they manage, which firm is doing more good for the world? And like I would say the case is pretty clear that it's Union Square Ventures. Andreessen Horowitz manages so much money and has so many partners. They end up investing in stuff that honestly I think is so dumb. Like surely like not all of the like surely most of them can't know they've even invested in this stuff because someone would say like this we shouldn't be doing this. Like crypto casinos, weird degenerate NFT play to earn games, like all this kind of stuff. It's just like some of it, the economics don't even make any sense. Like at some point, you're just managing too much money to make good decisions with it. And like that's probably irresponsible. You should have some way to balance that.
So this gets into the actual composition of what we think of as our tech startup economy, which is our innovation economy. And so, as you suggested, like with this cohort of platform VCs, of scaling VCs, there is a distinction in who they are choosing. And like this is leading to the advent of, and maybe not anymore necessarily, but like our whole windfall from the crypto startups. I don't know if anyone wants to like think about maybe what was going on with VR and AR a while ago. Where we're, and again, and this is where we start to get into maybe the more mysterious element that of, AI. There's a lot of bullshit in AI. There's a lot of companies that are just wrappers of stuff. And if they're not just wrappers and they have something cool, the big firms are just going to replicate it, within a short period of time and they'll be gone. Um, and then the overall thesis around AI. So do you see this as there is an alternative reality where we have a totally different composition of types of startups, of sectors of startups that would have otherwise kind of dominated or at least been more egalitarian than what seems to be these kind of distorted blow-ups of crypto, of AR, VR, of AI, and whatever we want to think about AI today.
Yeah, you can kind of see this as far back as you can go with venture capital. There is almost like because of the dynamic where like you have GPs managing money that need to go and raise money from LPs to allocate to invest. Therefore, they need a compelling story for the LPs. They need some reason to give the LPs confidence that like they know the right opportunity, they're the ones to go and find it, and it's going to produce massive returns. This is like a very Daniel Kahneman-esque like the hazards of false confidence or like the dangers of simple ideas. Simple narratives are much easier to sell than like complex uncertain narratives, even if the complex uncertain ones are much more honest and true. So if you go and tell LPs like whatever the like current consensus thing is, whether it's AI now or crypto or robotics or going back further into history, like some of the dot-com stuff or probably other things around there as well. There's always going to be bubbles of capital formation, and it's it's like it's you could look at that as like the root of this bifurcation between the two sides because the scaled platforms very much ride like bubble to bubble. They use those moments and those narratives to raise more and more money, and they delay the consequences of that further and further into the future by holding companies private for longer, so they don't have to reckon with the the consequences in the near term. At some point, I guess they do, but then there's so many other funds that come up and are deployed in the meanwhile. It's kind of lost in the wash a little bit as well. On the other hand, the small, like, let's call them like true VC or like classic VC small managers, they should specifically want to invest in the stuff that it's hard to raise money for, because that's where the alpha is. Like that's where they're going to get in a $3 million valuation instead of a $25 million valuation. That's where all the upside is going to be for them. But it is definitionally hard to raise money for that stuff because it's not obvious. But also like that's what venture capital is. So like if you're not comfortable with that, why are you allocating to the strategy at all? Then we're back into the point about like lazy managers at LPs out looking for easy ways to allocate money. So they go with the big trusted brand names like the buy IBM of venture capital. And they pick the short-term incentives, which means riding these bubbles, even though they predictably and consistently don't produce great outcomes.
Now, just to throw a quibble into this a little bit, one of a devil's advocate rebuttal might be the nature of what types of companies has changed to some degree, uh, parallel to the sort of overcapitalization of VC. And so, what I mean by that is we had way more uh, just the simple software company, whatever, where the economies to scale were great. You spend a little bit and you can multiply it infinitely and sell it. And so those economics were magic. Now, the types, for whatever reason is the case, of startups that have become popular are things that are actually capital heavy. And so, what I mean by this, there's this shift into kind of an emphasis on hardware, on reindustrialization of America, on collaboration with the military industrial complex, and then, especially, the ways in which we can feature AI into that conversation. So, is there actually a necessity to more dollars in VC and more dollars towards individual startups because the types of startup now is just qualitatively different than the prior versions where you actually need way more capital to get these things going because they're hardware intensive and not software intensive.
You could look at, going back to the comparison between Rivian and Tesla. Like Tesla, I forget the exact math, so forgive me if I'm off a little bit, but I think they raised somewhere around like $80,000 per car that they had shipped by the time they went public. Whereas Rivian had raised something in the order of like 500 million per car that they had shipped by the time they went public. And they'd also shipped like something like a tenth as many cars. So there's an argument that some deep tech applications certainly, or like some like heavier industrial, more R&D intensive applications are more capital intensive. But I think it can very easily become an excuse for companies to absorb a lot of venture capital money that they don't need to. Like Musk has definitely proved repeatedly now that you can reach some scale without raising a crazy amount of money, and doing so is very good for the company in the long run. Going public earlier, having access to cheaper public capital rather than the like relatively expensive in terms of like dilution private capital is way better for a company in the long run. If you care about the long run, which again is one of the problems here. But like then you could look at like SpaceX, that's often used as an example because it's 24 years old, it's only just going public now, and it's raised quite a lot, but for what it does, actually not that much. If you break it down by like number of satellites per number of venture dollars raised, or like number of launches per venture dollars raised, like it's actually very modest. So I'd be wary about using that as an excuse, but certainly like the fundamental truth of venture capital is like every company's different. They all have different needs, so there's no hard and fast rules for any of this. But the maybe the overarching point of all of this is that certainly founders should raise as little as possible. Like venture capital is always money of absolute last resort. It's the worst place to get money. But if you're so risky, no one else will give you money, do it, but get as little as you need.
Hmm. So, yeah, to continue some more of these aside kind of fun questions, uh, I think there's a way in which the overcapitalization theory plays into the conversation or debate that compares European VC and American VC. And there's often a chauvinistic, obviously, attitude towards people that support the success or scale of US VC and the relative like lackluster whatever X variable you want to show for European counterparts. Do you think that debate is actually like a function of the overcapitalization theory? And thus, like when people talk about this, they're failing to recognize the downsides of the American kind of perceived bigness.
It's an interesting question. It's definitely a very instructive uh, comparison between the two. You know, this is a controversial read on the data. Lots of American VCs or LPs get pissy with me when I say this, but European VC on a cash basis, on an actual returns basis, outperforms American VC. The returns are more efficient. Why is that? Because there's less money. That's all. There's less money, so there's less overcapitalization for sure. They're also a little bit more risk averse, but also just like law of large numbers, it's easier to get more returns on a smaller pool of capital. So like European VC does outperform. Now, the question then is like, is that a good thing? Or is it better to have a much larger ecosystem with, arguably much more important companies and a less efficient returns, but certainly much, much greater volume? There's definitely pros to that as well. Like the ideal really is probably somewhere in between the two. It's like early stage, like something like early stage size of capital with American risk appetite, and then some other mechanism that fills the like big later stage capital gap that VC doesn't do very well. But like there's no real easy way to navigate that.
Yeah, because I think that then leads to the conversation of like, well, what do you do about it? And then gets into the question of, well, what is the American VC community doing to sort of create new incentive structures? You mentioned the regulatory lobbying efforts. And there's all this conversation in Europe about like how do you stimulate innovation? There's the Draghi report, so forth, so forth. There's a lot of these guys that want to streamline things across Europe, um, which gets into conversations of who that actually helps, more of like the incumbent American firms that want to enter Europe easier, or the kind of like upstart European counterpart competitors. But I would say where I want to go with this is that you wrote an article also called like uh, the title is National Capitalism. And so I
Yep.
think that kind of connects well here. So could you just describe in a summary like way, what do you mean by national capitalism and what was the thrust of your essay there?
So the drive of that was really to look at a few different ways that like not venture capital specifically, but let's say like capital for tech and innovation in Europe, but also in any other more like emerging ecosystem like Canada as well. Um, like how that could be scaled in a way that doesn't produce the same problems that the US faces. So one of the arguments was that there's this whole case being made that Europe's problem is a growth capital gap, that there isn't enough money going into, Series D, Series E companies in Europe. That's where they really struggle, so they have to go to the US to raise money or they just don't manage at all. My response to that is basically if there were enough good companies at that stage, the capital would be available to them. It's maybe a like a bit of an efficient markets hypothesis or something, but the problem is there's just not enough opportunities in Europe, and that's all downstream of the fact that the early stage market is too small and too limited, maybe too risk averse, too fragmented. Certainly, there's like tons of problems around there. And if that was to be built up, if it was easier to just to like to raise a fund in Europe is quite difficult to do. So that is like low hanging fruit to solve. But if it was easier for a founder to access capital to build a company, suddenly the pipeline of opportunities may grow to really justify a much healthier, larger, broader capital environment in Europe. And there's a few reports on this. They're all mentioned in that article. You know, one finding was if you look at an ecosystem and you look at the total amount of government money that's going into venture capital in that ecosystem, you get a certain productivity benefit if you double that amount of money. But you get the same productivity benefit if you just move all of that money to early stage investing, which kind of makes the case that like maybe that's where the problem is. Like that's there's a few other like tangents on that as well. It's also it's better at job creation. Um, it's better at I think like growth in general. It produced more growth of companies too. But that's one of the three. The other one is more specifically aimed at the UK, which has a very strong like academic environment for startups, lots of spin outs, lots of very technical universities, where the government could play a role in there is providing more patient finance. So it can, if it gets returns on a 20 or 30 year horizon, that's fine. And if that makes the math work, then that's doable. If that allows government to support more university spin outs doing cool stuff, like that's worth looking at. And the third one was based on research by a guy called Andrew Lowe at MIT, like MIT's like finance institute, and he basically designed this like financial product for initially for like biotech, which is obviously very capital intensive, difficult to scale. Later for nuclear, he adapted it for nuclear as well, whereby the government helps to like form and like to form and to backstop private capital, both equity and debt. And it can do so, indexing lots of companies in these categories to help reduce risk, but it can really solve a lot of the problems that I think, when you make the case that maybe the argument for scaled venture capital is that it can solve some of these needs, like maybe there's a better way to do it. Maybe it's something like Andrew Lowe's model, which is comically also called like the mega fund model.
Interesting. I definitely recommend, again, listeners check out National Capitalism, that essay. All these articles are in their Substack called the Odin Times. Um, yeah, I see we're running up on the clock a little bit. Are you still free, or do you got a hard stop?
No, we can go a bit longer.
Cool. Um, yeah, so do you think that approach, especially with getting the government involved, the reason the government is iffy about going earlier is because they can't tolerate the publicity of the failure rate that is connected to that?
Yeah. Yeah, pretty much. Like it's the obvious and unfortunate problem of if you do this stuff, you have to be happy with a very high rate of failure. It's
Mhm.
natural, and governments aren't very good at that because of the optics of it. Also, if you're doing something where you expect to pay off in like 10 or 20 or 30 years, you're not probably not going to be the ones in power to reap the benefits of that, the political capital that that may accrue. So why do it? It's just all, it's like kind of like the whole venture capital problem is people with short-term incentives in positions of power managing money.
There you go. This always brings me back to the curiosity of the history of venture capital and how it developed. Um, where that again, we go back to, I don't know, the Renaissance or something to where it all started. But if we make that birth date, the 40s to 60s within the United States, um, the way that I kind of look at that is that even though there are these individualist VCs, the government as a buyer of first resort, I mean, the only buyer, I mean, the things that these guys were making really only had opportunity to be sold to the government. And there was a disposition of the government or the bureaucracy at the time where you actually, the decision makers weren't necessarily the politicians, but it were kind of the long-term horizon bureaucrats that were choosing what weapon systems to buy, what then like second order, third order technology that played into that. And it was only towards the late 70s into the 80s that like the unit economics of consumer electronics became attractive to mass scale, that we could have a consumer market that was able to prop up the companies that venture capitalists were investing in. So we
Hmm.
have this way in which the government actually played a very superior role, maybe not in always the acute ways that we talk about with the VC investments, but certainly the ecosystem these guys derive from, the R&D and institutions, academies, all that stuff, grants, and then the buyers of all these products. And then we move into kind of the consumer market, who is the main repository for all these products and services. And we've kind of been going about that, and in a weird way, with this sort of reindustrialization mantra, and like all these guys in California that are kind of moving out of the valley into doing all these hardware stuff and trying to lobby the government more and more. We're kind of returning to that relationship with the government in a way. Um, at the same time, your plan here describes a way where the government might need to play more of a role, but it does seem like the uniqueness of the El Segundo way is like the the startups and the VCs are kind of driving the choices and decision making of the government versus the other way around, which is like kind of the long-term vision of the bureaucrats needs to be the one that drives the selection process of which companies get through. Would you agree with that? Would you disagree with that?
Yeah, it's an interesting question. There's a good paper, could even be a Gompers paper as well. I can't remember. It's called like short-termism in America. Um, and it talks about like government involvement in venture capital, and particularly how in almost every case where it's attempted for political purposes, the government ends up pursuing like whatever the current obvious opportunity is. Like you could imagine today if like, and in fact this is happening, you can look at programs in the UK or in Europe where the government is suddenly interested in investing in AI companies. Like surprise, surprise. Do AI companies need the government's money? No, but it looks good. It seems like they're pushing forward innovation and like people in tech love it. So, it's a again, like it's kind of short-termism. But the paper compares that to the performance of In-Q-Tel, the CIA's venture arm, and they were investing in like long-term, like real needs, stuff that was way outside of any hype cycle, like stuff that they thought was really important, and they did very well. So there, I think like that does definitely implies there's a role for the state to direct what gets funded a little bit, or where they want to put money. I think to an extent, the whole like little renaissance in El Segundo is a response to the government having no direction on that, to not leading. So suddenly you have these people who are coming up and finding important challenges to solve because nobody else is solving them. The government isn't trying to, so someone's got to, and they're going to give it a go, which I guess is great.
Because this gets into an interesting dynamic where VC is intersecting with politics, and this causes belly of I don't know how like familiar you are with these certain strains in U.S. politics, but this like sort of reintroduction of protectionism and industrial policy, and how that has kind of created a niche within the new right of this kind of post-Trump wake, and all these sort of institutions pop up and guys that are sort of saying, hey, we got to eschew and jettison this sort of Cato Institute, neoliberal old way of running the economy in America, and we have to kind of get back to this like Hamiltonian vision. And so this is sort of a political philosophy that has emerged in the past decade, and it has combined with this. I forget the terms A16Z uses to describe this. American dynamism, I think it is. So
Hmm.
it's like it's this trend that they've consciously glommed onto, um, that they're working hand in hand with these politicians and political adjacent people to create the policy environment that makes the government again this like buyer of first resort or an investor or streamlining regulations for them. And so again, do you see that as you know, getting back to like the sort of nature of that will kind of stimulate eventually a good outcome? Or again, this is the cart leading the horse here, where the government cannot let these VCs and startups kind of dictate to them what is actually the right path forward.
That's a tricky one. I mean, I think the American Dynamism Fund, you know, I think they've done some important work, some great stuff. Like, and I know some of the people who were on that team, or a couple who maybe still are, and I think they're very well intentioned. I get the feeling from the outside that it was kind of a Andreessen Horowitz in the post-ZERP moment, trying to make up for a bit for like a decade of investing in software and crypto slop. They thought maybe like if we really lean into American dynamism, you know, this is will help repair our reputation a little bit. Um, and you can you know, it still exists today. They're still doing it, but it's relatively very small compared to what they're doing in AI and software generally. So I don't think it's a very big piece of all this. So I wonder how much of it is really just a brand thing. I'd imagine most of their like lobbying activity is really aimed at AI. But I don't know how effective they are, to be honest. You know, I know they're trying, I know they believe it's important. I don't know how much they really move the needle on that stuff. I don't, there's been a ton of talk about like the number of people who used to be in VC who have found their way into positions of power in the government today. I don't know that they've really had a great impact either. It doesn't seem like it to me from the outside. So I really do wonder how much of it is just a brand thing. Is this another reason that Andreessen Horowitz wants to like build an extra layer on what they present to LPs? Like, oh, we also have ties to the government and we have lobbying power and all this stuff. Like, maybe it's not actually that effective. It just sounds really good.
Yeah, to some degree, it can act as a smokescreen that also allows them to be in the same milieu and conversation of other things that need to get done, which is like regards to AI, or what I'm most familiar with is like just the trajectory of where crypto went. And I think again with that, like the performance and success of the crypto sector, aside what anyone wants to say about just like the inherent slop or scammy nature of it, is what I found out like a while ago was this basically that the entire crypto sector relies on a regulatory opinion of what is and what is not a security
Hmm.
and or a commodity and so forth. And so it's amazing in which so much money has been flooded into that space, um, which is entirely reliant on a subjective legal opinion. And the only way to make this a successful sector is to make sure you lobby the heck out of this to make sure no one dares, accurately, in my opinion, call a lot of crypto projects and their coins securities. Um, and so I think that kind of brings us back to the nature of how uh, overcapitalization, flirtation, and lobbying of the government um, sort of enables a selection error to occur in where people are targeting the innovation pipeline to go and which companies to fuel and which companies that kind of get left on the vine to atrophy and die. So yeah, so I guess that was a little bit of my personal rant on the state of crypto. But do you find that there are emerging all of these subjective, uh, kind of biases in terms of ultimately what determines the success of a given company or sector? As I said with crypto, this thing either fails or succeeds based on what lawyers call a security. And then is that type of subjectiveness popping more and more up across VC versus like this is an undeniably productive product and service and new technology these guys have invented?
Yeah, my feeling is it's more of the latter. I think historically VCs have been deadly afraid to invest in anything that's particularly well regulated. For these reasons, it adds a whole other layer of risk and uncertainty. I don't think that's really changed. Even I don't know enough about the defense industry and how that's regulated to comment on there, but like that could be one where I imagine there's some meaningful work going on, but otherwise I don't think much has changed.
Then, so yeah, I think we've kind of gone through the history of VC. We've talked about the current crisis. So let's do this. Within the next 5 to 10 years, if nothing changes, where do you think this takes VC? Is there a crash? Is there a big blow up? Is there sort of something that takes the center of VC and startups out of America and places it somewhere else? Uh, and then, so I guess worst case scenario, you could call it, or the no solutions are added to it. And then a second scenario of if things change in the way that you ideally see they need to change, where can the sector go in the future?
Yeah, I think like maybe just to reflect for a moment on past cycles to see like how this may play out. If you look at 2021, there was a ton of people raising funds, loads of money going around. There was also a lot of innovation in venture capital about like data-driven strategies, more differentiation, more diversity in all senses of what was getting funded. And there was, you know, smart organizations writing reports about like this is a disruption of venture capital, it's innovation in the industry at last. And it was also spreading more across other more diverse hubs. There was, a ton of money flowing into, the ecosystem in Africa or Latin America, certainly elsewhere in Europe. Even other venture hubs within the US were all growing. It was like decentralizing quite a lot. And then when the kind of correction happened in 22, what happened, like the way that played out is the same way it always does, which is wipeout of everybody on the periphery, everyone doing anything new, all the young, new funds all get wiped out, regardless of merit. Because like if you're a new fund, you don't even really have metrics to measure yet. So like there's no way it's meritocratic. They just get wiped out. Everything really unusual that's been funded gets wiped out because it can't raise more money. Basically, everything retreats back to San Francisco and like and New York and London, a couple of other places, to the big brand name firms that have maximum uh, kind of confidence from their LPs, even though these are the firms that probably did the most to contribute to the problem in the first place. And this happened exactly the same in the dot-com crash. Capital retreated back to San Francisco, even though the problem really kind of erupted out of San Francisco to begin with, and it killed tons of really interesting, cool places. Like there was, I think it was like the Silicon Hills in Texas was a big like industrial tech hub in the late 90s, wiped out by the dot-com crash. It had nothing to do with dot-com technology, like shouldn't really have had any exposure to the bubble, but the like systemic consequences were so bad it just wipes out everything. So that's all a maybe slightly cynical way of saying I find it really hard to see the big players today changing because even if there's a big correction, I think the same thing will happen again. capital will just retreat back to Andreessen Horowitz and General Catalyst and all the rest of them and Sequoia and so on. So what does it take for the market to correct enough to like really solve this problem? I don't know, to be honest with you. There is a possibility, I think the big liquidity events coming this year are like potentially very impactful. SpaceX is one. I have no idea how that's going to play out, but generally speaking, I like the company, so whatever, I'm willing to believe. OpenAI and Anthropic, certainly OpenAI, I think, has real problems. Those two companies, if those IPOs don't go well, if the value crashes before lockup and like the industry can't get the cash back out of them, maybe that's enough to start really asking questions about how sustainable this mega fund model is if it can't get money out of these big concentrated winners that it supposedly creates. Because that would also kill like Databricks as well. Like they wouldn't be able to go public. God knows how many other names in Andreessen Horowitz's portfolio would be stuck as well. So like that could be a big enough event that it creates real change, and that could result in a move away from so much focus on San Francisco. Maybe it would help encourage LPs to think about like diversifying their risk in all kinds of ways, which I think would be very good for the industry. I'd love to see more LP interest in Texas, Colorado, wherever, like all over the US. Like there's talented entrepreneurs everywhere. They should all have access to capital where they are, I think. The idea that you have to move to Silicon Valley today to start a company is like just obviously bonkers to me. So that's a long way of saying I find it unlikely that this reality changes, but there's a hope that it does, but that hope requires like a really nasty series of events to unfold this year.
Yeah, this gets at we didn't really directly touch on it so much yet, but what we hinted at is that overcapitalization leads to these later stage rounds, more money going to bigger private startups, and thus they kind of jumped the shark of where they needed to be to have a successful IPO.
Hmm.
And there's now a glut of companies that probably have risen above the point where it would have been attractive to IPO. And so the more, as you were describing, they start to have to IPO, um, them showing poor performance thereafter is going to be a sea change in how people perceive these things. And really, the only thing that's propping up the illusion that everything's so successful and innovative is the fact that these companies are staying private longer.
Yeah.
Um, so yeah, so I guess like does there need to be a watershed moment for these firms like to IPO? Like are like eventually will we just have to see like essentially the bubble popping where these things have stayed way too late and they got to go no matter if they like it or not?
You could probably look at the cohort. Like I think PitchBook did a count in 2023, somewhere around then, and there were like 600 uh theoretically IPO ready unicorns in the US. Companies that were at a scale where they should be able to IPO. They were old enough that they should be able to IPO, but they hadn't. And the truth is just because of the like as we discussed, like the private market incentives don't create really robust, healthy businesses. So had they gone public and then had to do all the disclosures and reporting of their financial health, like people would not have wanted to put money into them. So they couldn't go public. And I think what's happened in the 2 or 3 years since is a lot of those companies have either seriously downsized or just quietly vanished. And I think pretty much the same thing would happen again. It's incredibly difficult if you've raised billions and you fed that into a giant growth engine that actually isn't very efficient, and then suddenly that private capital tap is turned off, and you have to pivot that company into profitable growth. Like you're going to be laying off, the vast majority of the company. It's going to be a radical change. It's going to be deeply unpleasant. Hard, like very few will survive it, but there's no other option really.
and this could be something you're not as familiar with, or it's too much of a hypothetical, but does this kind of incentive structure where these companies want to stay private as long as they can and keep raising money, the trajectory of the distribution of money in public markets versus private markets, where there's way more in public markets, but the ratio from like 20 years ago to now is kind of collapsed. It's still hugely great, but like there is this acceleration of more and more money entering the private markets. So in that regard, getting back to kind of like the policy question, like I see a bunch of talk where the Silicon Valley type guys want more unaccredited investors to enter private markets. They want to create products that they can do this. I believe, if I'm remembering correctly, Robinhood wants to create sort of a variety of token products that sort of skate on the regulatory structure of crypto, but are essentially wrappers of shares in private companies. And so if you allow these sort of products to develop and sort of the regulatory minutia to shift, um, like, do you see that as a mechanism where, okay, now we can get these companies skating by even longer, and we'll like eventually get to like venture capital round X and Y and Z that will like we can forever put off the IPO of a reality hitting a brick wall.
Yeah, to an extent, it definitely extends it. If you think about OpenAI today, they in the last round, it really seemed like they scraped the barrel on every possible source for capital they could get their hands on. If you then said that this giant brand name private company that everyone in the world pretty much seems to be excited about, if you then say retail investors can buy those shares, then gradually over time, all the private capital can sell those shares, get liquidity, basically use the public as exit liquidity and bail out. And then if the company explodes, who cares? I think that's a very real risk. It's the like meme stock phenomenon in public markets, but would spread to private markets immediately. So I'm very hesitant about that. In general, the whole idea just seems ridiculous to me because private markets are opaque. That's why you have allegedly sophisticated investors making these decisions because they can navigate that opacity through experience and discipline and education. You just throw a load of retail money in there, it's going to be chaos. The one caveat to that is I'm very much for letting retail investors invest in like the angel rounds of super early stage companies because then there's no information asymmetry. There's no data to study. There's no opacity because there's nothing there almost. If they really believe in a company, if they want to invest, sure, they can access great upside by doing so. You know, they should be as a part of that process, they should be educated about risk and about like maybe they want to build a portfolio instead of just throw all their money in one company. But in general, I think that's a good idea. But the later you get, the more that information asymmetry grows, the more it really just doesn't make sense and just looks like the industry wants more exit liquidity.
That's a great way to describe it. That like that noble argument of, why are you allowing or disallowing the little guy not to participate in life-changing wealth creation is like, okay, allow them at the early stage when who knows? But what all these guys making the argument are using that to do is leverage them into like getting into the brand name private startups
hmm
that are way later stage, and thus, as you say, there's an asymmetry there. Um,
And also if people wanted retail investors to have access to like the wealth generation created by AI, guess what? They could have invested in Nvidia and Google and Microsoft. And if they'd done so, they probably would have outperformed most VCs. So, what is the benefit really?
yeah, yeah, great point. Um, yeah, so we that I think that covers the gambit. Is there anything that we didn't touch upon or something that is sort of your recent topic of choice that you're noodling on that you want to think more about?
The biggest, I like maybe the two topics that are most on my mind at the moment. One of them we kind of covered, which is the whole issue of exits. Venture capital needs to repair its relationship with public markets. VCs need to understand scale is not the answer. You need healthy companies, not just bigger and bigger companies. And actually, at some point, scale becomes a negative because growth is slower and you're more stuck in a certain way of operating. That needs to be resolved. And it should be because there's so obviously a need for like more smaller, earlier exits in venture capital, which is exactly what would happen if they went back to the like pre-global financial crisis or like maybe pre-dot-com era of like IPOs averaging around 8 years.
Mhm.
Totally healthy. Like get back to that. That's great. LPs would love it. I promise you. That would be awesome. So that's one thing. The other one is like in general, a lot of talk in venture capital in the last few years has been about the concentration, how difficult it is for emerging managers, and small GPs generally. There is at the biggest firms, however many partners they have, there is a structural bias towards consensus because they know they're going to be judged within the firm for the deals they bring. They know what deals partners are excited about. They know that, whatever thesis that the GP at the firm has written about recently, if they bring in a deal on that line, it's going to look good. Like there is a consensus bias at large firms. So there is a like an absolute structural need for many, many small firms in venture capital to find all the weird outliers doing cool stuff that's difficult to fund. That is what the base layer of venture capital, the like the point at which it interfaces with founders for the first time should be, in an extreme case, should be like tens of thousands of solo GPs who are like really high agency people with maybe just a few million, but they can fund interesting stuff and they can find it anywhere it is, anywhere in the country, in any industry, in any corner, whatever. That's what it should look like. And I think there's a way to scale venture capital to do that, especially, perhaps with AI plays a role in that as well. That's the future that the industry should be heading towards, rather than like scaled platforms. And if anything comes out of these next few years, I hope it's a recognition that like that would be the way to go.
Yeah, that just quickly reminded me of a criticism of VC that a person recently provided me with, which is they criticize the degree to which that there is any like alpha uh, in VC, that it is inherently just all the pray and spray. You just want to get as much exposure over all this volatility as you can to eventually like get those probabilities in your favor. So I think I know the answer, but do you agree with that criticism that there is actually no specialty or talent to being a venture capitalist and that it is all just sort of the luck of the draw? And if there's any skill, it's just your ability to get exposure over this volatility.
That's definitely like the scaled platform version
Mhm.
of like, and particularly it's kind of like a smart beta strategy of you want to index, but you want to index the areas with the most heat because that's where the most capital is going to be fired into that after you. So you'll get the markups and the like the paper growth of your investments. If you're indexing the hot parts of the venture market, like you are providing like I guess like good looking but very fragile beta. There's still definitely small managers who provide great alpha, but they are, as I said in the beginning, increasingly like a rounding error of the total activity.
But would you describe like kind of thinking of that ideal, like where things should be? Like it should be actually we should be scaling in aggregate those types
Yeah,
versus the beta
yeah,
chasers.
exactly, exactly. Like I don't see, a common criticism of well, not criticism so much like a point of friction with small managers is for a big LP. It's easier to write one big check to Andreessen Horowitz and they manage all the money and they do all the investing, rather than writing, 50 individual checks to 50 different GPs who all work independently. because of, reporting reasons, paperwork, compliance, all this stuff, admin, it's a headache. But like surely that seems like something that you could solve with AI eventually. If you could take all the friction out of that process and suddenly funding 50 managers is as easy as funding one big one, I would definitely rather fund the 50.
Mm, interesting. Yeah, a diversified portfolio of VC funds versus of individual companies. Um, yeah, so then keeping on this theme quickly, does does that capacity to have like domain expertise as a VC, like again, um, does that actually matter in how inherently risky these things are at early stage? Like, does the fact that you have a guy that made his money in his career, he's like 40 years deep, he knows the products, he knows the market, and he has a vision of the future, does that guy does that domain expertise and that vision beat the statistical improbabilities of investing at that early stage? And thus, like, it's an illusion that we provide that person clout, where again, it just sort of like if you have a person that has a very scientific way of doing pray and spray, should we actually, you know, consider that more of the statistical, you know, likelihood and care less about these domain specialists?
I think that there's merit to both models. Probably the scientific spray and pray approach would catch a load of interesting stuff that nobody else would. Um, and it probably essentially means like a narrower band of returns. Like they wouldn't fail quite as badly, but they would never succeed quite as much either, compared to like the classic VC archetype. Although like what what experience or education or background actually makes a good VC and like feeds good decisions is an area that's like fairly poorly studied, not very well understood. And a lot of the assumptions that you'll hear about it, like, MBAs or Stanford grads or people who used to be founders, all this kind of stuff, like it's all mostly nonsense. Nobody really knows. Like Cyan Bannister is one of my favorite examples. Incredible investor, amazing angel investor, has like maybe the one of the best, if not the best track records in the world, I think. And she's a kid who grew up on a Navajo reservation and like I think she dropped out of high school or something. Like just the most wacky idiosyncratic background. And like maybe that's what you need.
Hmm.
As long as they have like not to sound too much like Rick Rubin, but as long as they have like confidence in their taste, so they're not going to be pushed around by biases and insecurities. Maybe that's the kind of person you need. Or maybe you need hundreds of those people everywhere.
Yeah, and this is where we can really zoom out, and it gets in, to the sort of stuff that I sort of intersect these particular stories of VC into a broader economic philosophy, which is again like entrepreneurship is actually a very important, like broad concept within how our economies develop as a whole and how we keep the growth rate up. And so if we don't have a firm grasp of like what exactly is at the very front stage of the economy, like what are these investors doing? Like how are they acting? And it's like, are they actually fulfilling the role of like a like the clinical definition of what Joseph Schumpeter defined as like an entrepreneur?
Hmm.
Whether it's like the executive of the company or again the investor, like they're both acting as entrepreneurs, i.e., trying to listen to the forces of supply and demand and like have a vision of what the future is and meet those things. And so if it sounds like if we're like losing out on the like alpha seekers and we're losing out on the domain specialists and we're just kind of going into these uh, spray and pray and these like scale beta chasing VCs, like we're actually corrupting what Schumpeter was talking about as an entrepreneur. And we're divorcing like the critical act of what that is from the entire process.
Yeah, you could boil it down, I think, in a very simple way to the idea that like money should chase good ideas. And when you look at the scaled venture firms, it's really like ideas chasing money. It's founders maybe increasingly opportunistic founder. Like I struggle to even really call them founders, but like if they know that Andreessen Horowitz is going to invest a ton of money in AI, and they know they have the right background to fit that archetype of a founder, and they can come up with some plausible sounding business, they can go and raise a ton of money. Like, is that good for the world? Is it good for innovation? Of course not. It's not going to work out. But if you flip it the other way around and you say the capital should always try and find the good ideas, that's why venture capital has historically not been scalable. It's very difficult. It's full of friction. It requires a ton of weird, idiosyncratic people going out there and like projecting their own view of the future onto the world and seeing what fits, which, clearly doesn't work if you have a scaled venture platform where you've hired, 24 associates out of Stanford who all have a very similar view of the world.
Yeah, and to connect this again to the sort of broader economic uh, philosophy angle here is that there is an interesting comparison one could make to development economics and VC, and there's like an inherent affinity there because what is development economics if not like the study of how you produce growth?
Hmm.
And so, like, kind of the far end developed economies that have an innovation pipeline, like you can see that there's some synergies there to like how you get a less developed country going in the first place. And what an economist that I like that I feel represents kind of a more correct way to look at this is Erik S. Reinhardt. He's a Norwegian, really good writing on the topic. And if I could boil down his points, it actually is sort of what you just said, which is like, are we having good ideas chase money? Are we having money chase good ideas? And he would go with your preferred, where like it's the fact that like qualitatively the ideas are the thing that we're concerned about, not just the application of capital. And like the application of capital, like divorced from any qualitative nuance to it, is actually like this kind of like 19th century, you could say like capitalist, or even like again like this is like how Marxists would view it as well. Just the sheer deployment of capital kind of begets the innovation, where again like it's kind of the reverse, and this is where Reinhardt goes to the developed world or developing world, and he says, look, I can study the fact that we've deployed capital across these different countries, and the sheer act of deploying capital does not just beget growth and innovation and can cause massive problems. And it's actually the other way around, where we have to actually choose in a very qualitative way. The economist out of Harvard, Ricardo Hausman, has another great series of writings on how you make those decisions and product trees and all this stuff. Um, and it comes down to this fact that if you do not pick the right types of sectors, the right types of products at scale and so forth, you will not actually get the growth that is healthy and desirable. And so I think that like circles very well back into what you've been describing with VC, which is that we have this bias now where it's all about just the deployment of capital, and we throw caution to the wind, and like the deployment capital will be get the results by virtue of capital being deployed.
Yeah, I
So
also think we've
yeah,
got to mention Carlota Perez as well in this conversation. Like her cycles of like the techno-economic cycles of going through like the initial phase of like hype and real like speculation about a particular technology or moment of technology and what that produces, which is initially like really cool, important technology gets funded, but then it turns into like real wasteful speculation, you know, financial engineering that turns toxic. It gets very wasteful. And then as eventually you hit like what she calls a turning point, which is often government intervention, where this technology is kind of forced to deploy out across the the economy and like drive more productive growth for everybody. It's a bit more egalitarian. Problem she would say is like that turning point should have been the financial crisis in 2008, but the banks got bailed out, so it never happened. So we've been stuck for way longer than we should have been, for a historically unusual amount of time in this speculative initial phase.
Hmm. It's interesting because Carlota Perez is a founder of kind of the what should we call it? The title they call it the Other Canon Foundation. I don't know if you're familiar with this, but the
No?
gentleman I mentioned, Ericus Reinhardt, he, in collaboration with Carlota Perez and other thinkers, created what's called the Other Canon Foundation, and it's, as I said, kind of this unique way of looking at the economy, of kind of creating a different series of concepts and ways we think about the economy outside, like especially the neoliberal tradition, but as well as sort of the other more popular versions of that, and even criticisms of that from like more of the left side. And I would say, like, if I'll speak for them, if they could probably center it on like a key point, is that they really like try to emphasize the idea of like what is innovation, which is, again, it's
Hmm.
funny when we talk about startups and VCs, it can be divorced from like academia and like kind of broader things to some degree. But these guys in academia are really like getting at the point, like, no, like conceptually, philosophically,
Hmm.
economically, what is innovation? How do you do that? How does that go about? And how does that basically keep jumpstarting kind of the virtuous cycles of development and growth that you need to, have a functioning economy. So I recommend checking them out to you or to the listeners. That whole collection of folks has like a bunch of great writing, and really does a great job of marrying this like early stage study of innovation with the more macroeconomic concerns of like the bigger questions of our economy.
Interesting. I will definitely check that out.
Yeah, yeah. Eric's book that I always recommend is the great starting point, which is how rich countries got rich and poor countries stay poor. And yeah,
Good title.
he wrote that. When did he write that? It says 2019 here. I think he wrote that actually earlier. Um, but it's a great book that like gets to the heart of really carving out that space for this new conceptualization of like how to think about the economy, and again driving out like it's not about the deployment and accumulation of capital from a right or a left wing perspective. Like it's there's that, but like you got to center it on like what is the study of innovation, entrepreneurship, and the qualitative difference in economic activities.
Hmm.
Yeah.
Interesting.
So glad I could shoehorn my preferred broad economic philosophy into that. So that was fun. Cool. Okay, so any last parting thoughts before we sign off?
I think we've covered just about everything, more or less. I'm just like, there's definitely other things I could keep talking about for hours, but like maybe that could be a future episode.
Awesome, awesome. Plugs, future writing publications that you want people to check out.
Most of my writing these days is on the Odin Times, which is blog.joinodin.com. It's generally like, yeah, long form stuff, and you'll get a flavor for it from this conversation. So if you enjoyed that, feel free to go and subscribe.
Great. All the links will be in the description below. Encourage everybody to go follow, read, listen, anything you guys are putting out. And thanks for joining me today.
It was my pleasure. Anytime.